Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountants of India, I welcome you all in today's 156th CP program organized by AASB of ICI for this year. In the form of the webinar, we have organized various webinars, and today again the topic is very important and very relevant. That is the key considerations in the audit of real estate sector. And in order to tackle this very important sector and topic, we are having with us very learned, very respected from our own chartered accountant fraternity, CA Vikas Kumarji. So on behalf of AASB of ICI, I extend my warm welcome to you, Vikas sir. Welcome to you, sir. Namaste.
Thank you. Thank you.
We are having with us CA Drishti Kapila ji as a moderator for today's webinar. So on behalf of AASB of ICI, I also extend welcome to Madam Drishti Kapila ji to moderate this webinar. Welcome to you, Drishti Madam. Namaste.
Thank you so much, sir. Thank you so much.
Not wasting much more time, I request Madam Drishti Kapila ji to please start the proceedings of the today's webinar. Over to you, Madam Drishti ji, please.
Yeah. Thank you, sir. Thank you so much. So, good evening, everyone. Myself, CA Drishti Kapila. First of all, I would like to thank this Auditing and Assurance Standard Boards of ICI for providing me this valuable opportunity to be the part of this insightful session. I welcome all the members to this knowledgeable webinar on key considerations in audit of real estate sector. I would like to welcome our honorable guest speaker, CA Vikas Kumarji, and thank him for joining us for today. Before handing over the session to CA Vikas Kumarji, I would briefly like to introduce Mr. Vikas Kumarji. Mr. Vikas Kumar is a qualified fellow chartered accountant with more than 30 years of post-qualification experience. He is a partner with TR Chadha and Company LLP since 1996 and is the CEO of the firm. He has an extensive experience in statutory audits, forensic audits, business advisory services, etc. in various industries. He is also specialized in financial services with extensive experience in audit of large banks and NBFCs such as State Bank of India, Bank of Baroda, Standard Chartered Bank, Tata Capital Housing Finance, PNB Housing Finance, etc. He is a regular speaker and panelist at many conferences and seminars of ICAI, SEBI, CAG, etc. on various topics including accounting standards, bank, NBFC audits, etc. He is also a technical reviewer of Quality Review Board constituted by ICAI and Government of India, and he has also done various inspections and special audits on behalf of SEBI, RBI, IRDA, etc. He is also a member of Group of Revision and Guidance Note on Audit of Banks and for revision of LAFAR report for banks. Now, I would like to hand over the session to CA Vikas Kumarji to enlighten us with this knowledge on the topic, key considerations in audit of real estate sector. Over to you, sir.
Thank you so much, Drishti, for a lovely introduction. So nice of you. Thank you so much. Friends, first of all, let me thank the AASB of Institute of Chartered Accountants of India for inviting me here to talk to you or to interact with you on this special topic or a very important topic with respect to the key considerations in audit of real estate companies. So we all know the importance of real estate companies in India. So this, I believe and I hope that this topic, when we are going to discussing, will be of a lot of immense benefit to each and every one of you. And I will also be happy that if before the end of the session, if you have any questions, you can put it to the organizers, and they will definitely call out all the important questions. And then we can discuss and have a chat on all those questions which you are wanting to have. So with these few words, let me share my screen with respect to the presentation which I have. Once you see it, just let me know. Are you able to see it now?
Yes, sir.
All right. So thanks once again, friends. And we start discussing with respect to the key considerations in the audit of the real estate sector. You all, I'm sure, must be doing or dealing with various companies into the real estate sector. And that is why you are present over here. So when we talk of the real estate, what do we really mean by real estate? We would like to start with that. So the terminology, the real estate, actually will include lands as well as the building and the rights thereon relating to that land. So if there is any entity which has a land, then of course it will be treated as real estate if they are dealing with the land. if they're dealing in the land, they're constructing some structures on that land, in that case, it will be treated as a real estate. And when we talk of land, it will include anything above the land or even below the land, and any building which they are going to construct on it, any structure which they are going to construct on it, will be treated as part of the real estate only. Real estate sector will also include if you are doing any purchase or sale of plots, like after taking land, suppose you are doing the subplotting and you're doing plots and you're selling plots, that will also be treated as part of the real estate sector only. And all the construction or development which is to be done in that regard will also be treated as real estate. Friends, you all are aware that real estate is one thing which is imperishable. There is some company which is saying this in trading. So naturally, trading is a perishable product, whatever product they are dealing in general, except few. Whereas real estate is one which is imperishable asset. And also we have seen, not only in India, but worldwide, that generally it is increasing in value. It is possible that 1 year there is a blip, 2 years there is a reduction. But overall, if you will see the trend for any block of 5 years or any block of 10 years, you will find that it is increasing in the value. So that is why real estate is an important factor. Also from Indian perspective, one important thing relating to real estate, why it becomes an important sector is that is one of the most favored destination for FDI. There's a lot of money from worldwide which is coming to India and they're coming to invest in real estate. So this is one of the most favored sectors so far as the FDI is concerned. And the government also puts a lot of focus into it. And the reason for that is very clear. कहते हैं ना रोटी कपड़ा और मकान. So this makan, this real estate is one of the important thing which everybody aspires to have, everybody wants to have, and accordingly the government also gives a lot of focus to see that how this sector can thrive, how this sector can be encouraged more, how this can develop further. So there is a lot of focus by the government, and accordingly again this becomes a very, very important sector. Having that importance also brings the risk and regulations, because you must be aware that real estate sector, though it is very, very important, critical, and a lot of focus by the government, by FDIs, but this is also has been one of the sector which has always been plagued with many adversaries, in a sense. You know, they have been told that there are a lot of cash transactions into the real estate sector. There have been a lot of diversion of funds in the real estate sector. Many of the builders have taken money but not delivered the project, not delivered the flats, which is impacting the common people. And once common people are getting impacted, of course, the government becomes concerned. So because of all that, from the government side, there is very strong governance and very strong regulations relating to the real estate sector. And with that only the RERA, you all must have heard this, the RERA came, wherein they brought in many regulations, many stuff which can help to regulate this sector so that this sector can work much better, and the chances of diversion or chances of non-delivery of the flats to the customers, the end consumers, is minimized. And not only RERA, they also brought in the Benami Act, because this again was considered to be one of the sector where a lot of cash can be deployed. So considering all that, a lot of regulations came, whether it's RERA, whether it's GST, whether it's a Benami Amendment Act. So all those regulations came. And you all know when there are more regulations, of course, from the audit side or from auditor side, it becomes more important to really see that we do the work or do the audit in a manner so that there's nothing getting left out which can be considered as a problem later on. So that is one of the reasons why this sector becomes very, very important. And in this sector, the last thing which I wanted to talk on this industry was that there are a lot of sunrise segments which are coming into it. You must have heard the word REITs. So there are many people in the sector who are getting their REITs listed. They're bringing those structures to raise money. There's a lot of focus on the warehousing, with many people like Amazon or Flipkart or any other companies which is into the logistics coming into play. There's a lot of need for the warehousing, and which again resulted into a lot of work on the real estate sector. So there are various sunrise segments relating to the real sector which is in place, and which is given new impetus to this entire industry, where how to really grow about it. Having now to go further, what are the main segments of the real estate? You all know, first is residential, because we all stay in house. So residential real estate is one of the important aspect of any real estate. Then commercial, all commercial buildings will fall part of the commercial real estate. Again, this is a very large sector because all offices are housed into the commercial real estate. So that is again a very, very important play. Third is on the industrial real estate. You know, there are many industrial parks which have been built where there are a lot of industries which are coming in that one complex or one park which is being developed. And so that is why those are the industrial real estate. And the last is on the hospitality side. All the hotels, though it is a hotel and being run as a hotel, but it's primarily, if you see that sector is nothing but a real estate because they have a land, they are developing a property there, then they're ultimately renting it out as a rooms and running that hospital. So that is also a part of the real estate only. Considering these key segments, the players also come into the play. The first is like landlords or the owners. Of course, whosoever is owning that land or that real estate is the first and most important player in this segment. So those landlords and owners. Second is the builders or developers or contractors. So maybe they are buying the land and then doing a construction that will be the builder. There is possibility that the land is owned by somebody, there is a joint venture, and then the development is happening. Those are the developers, or it could be on a contract basis that somebody is just giving a contract to other player to do that construction. So those are the contractors. So these are again a very important players in the real estate market. With the landlords or the builders or developers, the third most important element in this is real estate agents, because they are the people who act as a matchmaker between the builders or the landlords and the actual consumers. So they play a very important role in the entire ecosystem of the real estate. And that is why when we go to the RERA provisions, RERA, when they wanted, they have not only asked for the builders and the developers and the landlords to get registered, but they also wanted the real estate agents to be registered with them. So they are again a very important player in the entire scheme of things so far as the real estate is concerned. Then tenants, of course, the people who take the premises on tenancy basis are again an important player, and investors. Because this has been one of the market where not only the end users, but even investors have been putting money, and they wanted to, they definitely want to earn money, but they have acted as a player to see that initial construction can be done much faster and better. In case if the actual users are not there initially, there could be investors who will put in money, help to get the project completed, and when then the things are at a better stage, they will be in a position to sell it to the actual users. So these are the key players in the real estate market. Friends, as I have said earlier also, if there are any questions relating to anything which I am talking now, rather than waiting, you can have your questions sent now. And of course, it will be taken up at the end, but then your mind can come, your question can come more clearly when you are sending. And when you are sending the question, please ensure that you write the exact detail which you want to know or understand. Right, friends. Now going further, what are the major regulations governing the industry? As I was saying that real estate is one sector which is highly regulated. And the reasons which we have already discussed, because it is impacting the end user. So it means it is impacting. And accordingly, the government has brought in various regulations. From the concept of the ensuring that the projects are being done in time, like RERA, which I have talked about, Real Estate Regulation and Development Act 2016, which came. So this is one act which redefined the entire industry, which helped the entire industry to grow in a very organized manner. And it became difficult for the real estate players to play around the game or to the regulation. So this is one thing which government brought in. Similarly, considering the importance of this sector, even ICI has given a guidance note on accounting of real estate transactions. It had come earlier also, then it was revised last in 2012. This is primarily from IGAP perspective, this guidance which is there. So this guidance note again gives a lot of understanding on how the accounting should be done with respect to the real estate players. So I will strongly advise each and every one of you to familiarize yourself with this guidance note, because it can help you to understand how the entire accounting will be taken care so far as the IGAP is concerned. Then there are many other regulations or the act which are in place, which will play into the scheme of things when you are doing the entire transaction on a real estate, or even with respect to accounting at some point of time, like Indian Contract Act or Transfer of Property Act, Urban Land Ceiling Act is again, which was an old one, which has come. Land Acquisition Act, Rent Control, that you cannot get rent beyond a point. Registration Act, Indian Stamp Act. Income Tax, GST, of course, is the common, or Companies Act is common. And if there is an FDI guidelines for a real estate, this is a separate one which has been given by the Ministry of Commerce and Industry. So that talks about that how the money which has to come from FDI, what are the guidelines, how they can put in money, and how would they go about it. So these are the key guidelines, which is or the key regulations which are there with respect to the real estate industry. I hope I am clear so far. To start with, let's talk a bit on RERA, which I was talking about, that this has come from 1st of May 2017, which the government brought in to really see that the real estate players are much more organized, right? So why this was basically what the need of this act was primarily to provide a regulatory authority. So there is a clear regulatory authority now which governs the real estate sector. So you do not have to go here and there. RERA gives all the approvals, and RERA takes the reports, and they keep on telling a lot of things. So this regulatory authority was created to govern the real estate sector. With this RERA, one of the important things which the government wanted was transparency. So real estate sector, as I said, it was plagued with a lot of cash transactions, and it was treated that if you have cash, you can park money in the real estate. So many times why it was very difficult to detect was that there was no online clarity that what rate you have sold, how much flats you have sold, what transactions you have done. Now with RERA coming, there is a lot of reporting requirement by all the real estate players to them. So that brings a lot of transparency in the entire sector. So that, I believe, was one of the special reason and main reason for the RERA to come. And the third and important one was with regard to standardizing and making the entire sector work in a professional manner. So in standardization and professionalism in the real estate sector was another reason why this act was required. And this has brought a lot of course, because all the reporting, all the data which is coming, which any public can also access and see, has resulted into a lot of clear understanding and transparency and standardization for the real estate state sector players in India now. As I was telling, that this act deals with the registration of not only the real estate projects, any project which any builder wants to bring in with certain criteria, which I will come forward, will have to be registered with the RERA authority. And not only the projects, but also the real estate agents, which I was talking about, that they were wanting not only the builders or developers to be registered for whosoever is doing the real estate projects, but also the real estate agents. So unless and until you are a RERA registered agent, you can't deal with the projects which are registered with RERA. So if you want to deal with in a project which is registered with RERA, the agent will also have to be registered with RERA. Now, to which projects RERA registration is mandatory, right? So if you can see from this slide, any project where there is where any builder who wishes to build residential or commercial project, and that has area of more than 500 square meters. So if the area is more than 500 square meters, or the number of apartments proposed to be constructed exceeds 8, including all phases, in such case, all those projects will have to be registered with RERA. So that is a specific requirement which is given in the Act, that these are the cases which needs to be registered with RERA, and that is where it is. What are the other key aspects of RERA? What all they are talking about? Like first, financial audit. So there's a lot of focus by RERA on the finance. So this Act mandates that the promoters have to maintain a separate bank account for each project. So if there is a builder which is having 10 ongoing projects, for each project, they need to have a separate bank account. And a chartered accountant in practice needs to carry out financial audit for all those projects. And the main purpose is to see that the funds collected from buyers are being used only for those specific projects and nothing else. So no money should go out, no money should be misutilized, there should be no diversion of fund. So if there is any project for which you are getting money by selling flats or land or whatever you're selling, the money should come into a separate bank account, and that money should be utilized only for the purposes for that project, like for buying the land for that project, or for construction purposes, or other expenses relating to that project. So only for that project you can spend the money. And that is the main purpose of having a separate bank account. So the financial discipline or financial control or financial knowledge was one of the key aspects of RERA, which they have brought in. Second, not only from finance side, but also from the project side, they wanted to have a clear knowledge and understanding, not only for RERA, but for the public at a large. So if you want to, you have invested, say, some money or you have bought some flat in a project which is RERA registered. Now, if you want to know the builder, when they have sold, how much they have sold, to whom they have sold, what are unsold inventory, everything you can get from the reports which is getting submitted by the builder to the RERA. You can go to the RERA site or even to the developer site and you can find all those details. So they mandate that they have to tell the physical progress of the project and compare it with the timeline which they have given at the time of project registration. So at the time of, say, project registration, the builder has told RERA while getting the approval that these are my timelines. X will be done by this date, Y by this date, Z work will be done by this date. So what was the timeline given and what is the physical progress that they have to provide on a quarterly basis, on a regular basis to RERA, which also gets published on the website. And this actually helps RERA first to identify the delays and to take any necessary actions, if any required for that. And even for the investors, even for the buyers of those properties who are there. If they want to know, they can find it out from those project progress reports which are being submitted. Third, quarterly reports and annual audits. So again, promoters are required to submit quarterly reports to the regulatory authority. It will contain further details like not only project progress, but it will have fund utilization, any modification, any changes done in the project, any litigation going on. So all those things are getting reported in the quarterly reports to RERA, as well as annual audit reports are provided to RERA. So from these reports, RERA come to know what is actually happening on that project, and they try and control as to how the entire things are going on. They ask the relevant questions. They ask the builders to give further clarification wherever required. So these things which is being submitted to RERA by the builders has helped the entire ecosystem in the industry, and it has brought a lot of transparency. And also, I believe that it has also resulted into not only transparency for the people who are the user, but even for the developers, for the builders, the people who are good people who are able to do this, they are getting a much better name and they are able to sell more projects and they are able to do much better as compared to the others who are not able to comply with this. So this has been a win-win scenario for almost everyone which is part of this entire ecosystem. We go further now, as I was talking, that you require to have a separate bank account. And what is required is that the minimum of 70% of the amount realized for the real estate project must go in this bank account from time to time. And the withdrawal from this bank account can be used only for the project. And that also you will have to tell that what is the project completion which you have done, how much you have done. You have to give certification which is given by the engineers or architect or CAs that what you have actually completed, how much amount you have withdrawn, whether it is matching with what work you have done, or is there anything else. So all those details have to be given to the RERA. Also, there was a regulation which mentioned that the promoters are not allowed to accept anything more than 10% of the cost of the apartment or plot of flat as an advance payment. So if somebody wants to sell something at 20,000 rupees a square feet, then the 10% of the same, that is 2,000 rupees per square feet, is the maximum amount which you can take as advance before any written agreement of sale is registered. So you must be aware that earlier the builders used to take a lot of money and used to take huge amount from the customers, and the actual work has not even started, the actual agreement was not even done, written agreement was not done. So those were the issues which are plaguing the industry. So this clause was brought in that you cannot take more than 10% of the amount as advance payment or as application fee or whatever name you call it before the written agreement of sale is registered. Also, there is a requirement that each project will have to get audited within 6 months from the end of the financial year by a chartered accountant. So this is also something which has been mandated by RERA. So friends, these were the key things. There is a lot of other things. I'll urge all of you to go through this act whenever you are doing the audit of any builder or developer, you must familiarize yourself in detail with respect to the RERA guidelines, because if there is anything which is not getting complied with, it will be your responsibility as an auditor also to talk on that what are the non-compliances relating to RERA, because the implications of non-compliance could be significant in these cases. We go now further on the from an auditor perspective, that when I do audit of any sector or any entity, I am supposed to do a assessment of the risk of the material misstatement. So I do this ROMM, risk of material misstatement, which is primarily also given into the SA 315 standards on auditing. So we have to understand the risk. So I always believe that whenever we are doing audit of any company, first and foremost thing is we must familiarize ourselves with this sector, what industry it is working, what are the key risks relating to that industry. Because unless and until you understand the sector, the industry, it will be difficult for you to dovetail or to understand the key risk and dovetail your audit plan according to those risks. So first and foremost, we must understand the risk of that sector. I have tried to list down some of the key risk areas which I believe is there in the real estate sector. Like we will discuss more in detail on some of them, which are critical ones. But just to talk on the key risk areas, it includes possibilities of leakage. So revenue leakage is something which is there in almost all the industry. And that is almost most of the time a key risk for any audit to be done. So revenue leakage is one. But another word which is there in which is here in the revenue, that is on the fraud, right? This one sector is prone to frauds as well, because here the prices are such which are getting negotiated between buyer and seller, and there are fluctuations between the pricing of the buyers and sellers, and hence there are chances of fraud being higher in this sector, and hence this is one of the key risk factor that there are possibilities of fraud in revenue. Second, subcontractor claims or cost inflation. There are two scenarios. Sometimes the builders do the construction themselves. In such cases, the cost inflation come into play. Or in some cases, the builders subcontract the work. So maybe there is one subcontractor to do the entire work. Maybe there are 5, 6 different subcontractors, one doing civil, one doing mechanical, one doing furniture. So there could be various varieties of subcontractors who are being appointed. So the claims made by the subcontractors, because that is the major cost, apart from the land purchases, that is the major cost which is being incurred. So that becomes a key risk areas in case of any real estate project. Third, purchase and vendor selection. So whatever material you are purchasing and whichsoever vendor, what is your process around that, right? So how you are actually selecting the vendor, how you are determining the purchase price, how you are seeing that you are getting the best pricing is again a key risk with respect to any real estate player. Construction estimates. So when we go to the revenue accounting for any real estate player, you will find that the accounting here is linked with the fact that how much amount you have spent so far and how much amount you are going to further spend in future. And the entire accounting is linked to that. And accordingly, this construction estimates as to what further is going to be, what is going to be your cost, what are going to be your timeline, is again a very, very important element and a very key risk area for this real estate player. Fund diversion. As I was telling that the sector always had this risk, always had these problems, and that is why RERA came. Of course, with RERA, these have come down significantly, but still, the industry is such where there are possibilities of fund diversion. So like even 70% amount is getting transferred to a separate bank account, still 30% can still be used as per the need or the wish of the builders or the developers. So that again is a huge amount, and the chances of fund diversion is significantly higher, because what used to happen is that many times builders used to have multiple projects. So one project they have got the money, they think it will take some time, so they put that money to buy another land. Now that land, maybe they have bought, again new construction will start, it will take time. If it gets lingered on, if it gets time, they have no money to even do the current project for which they have already sold the inventory and got the money. So that type of cases used to be there, and that is why fund diversion is always a high risk area with respect to any real estate player. Then regulatory approvals and clearance. This sector has significant requirement of regulatory approvals, starting from getting from your municipal corporation to fire, you name it, and all sort of approvals and clearance is required by them. And no project can fructify or no project will go to the stage where they can make money unless until the regulatory approvals and clearance is in place. So again, this being a very highly regulated industry, it is important that when we do the audit, we check on all the regulatory approvals and clearance, because even the accounting, because our standard says if the approvals are not in place, even on POCM basis, you cannot do the revenue booking. So regulatory approvals and clearance is a very, very critical area, and we as an auditor would also require to go through that. Interest rate risk is of course a risk at most of the places. Here also, because they definitely borrow money at the initial stage significantly, and hence here also the interest rate risk is one of the key risk areas. Pricing of property, because the pricing of the property keep on moving. If it increases, because you have estimated certain cost, and if there was an estimate in the pricing of the property also, if the market is increasing, your risk is different. You are able to get more money. If the market is on a deflationary process, the pricing will be different. So that again, because the price fluctuates a lot in this industry, so this pricing of the property also becomes a key risk area, because it is something which is not there for short term. If you're buying some inventory and you're going to sell it, it may take 1 week, 10 days, 15 days, but the project which you are constructing, it gets sold over a period. Sometimes it is even 3 years, 5 years, 7 years, 10 years for the project to sold. And since the period is longer, and hence the pricing will also differ, because it is not a short-term thing. And that is the reason the risk of pricing becomes an important element into any real estate player. Inflated land prices and cash transactions. So again, this was an area where you can have a land purchase at inflated value or undervalued, and there have been a lot of cash transactions. So naturally, you will have to be cognizant of the fact that this is an industry where there used to be significant cash transactions, and there could be even now. So our audit procedures should be such that we are able to check with respect to the inflated pricing or cash transactions which are there. Facilitation payments, because of the regulatory requirements, because of the regulatory approvals, naturally many times these type of payments are also possible, which are being accounted in a different manner in our financial statement. So when we do the audit of any such player, we have to keep our eyes and ears open to see that is there anything which is coming and getting accounted here for which there are no proper supporting, because these type of payments are very quite common in this industry. Ambiguous sale and purchase agreement. So whenever there is a transaction where the builder is entering into a sale agreement with the prospective buyer or with the actual buyer, in such case, what are the terms and conditions of those sales and purchase? That also becomes important into the real estate player, because any ambiguity there can impact the entire accounting and also the entire transaction which is happening or going to happen. So those, though we are not legal experts, though we feel that that is not our domain, but I believe that that again is an important area which we must see, because there could be financial implication because of this ambiguous agreements if somebody is entering into. Related party transactions, again, this is a burning topic everywhere, every sector. Here also, I mean, this can be misused here more. Suppose you want to show more sales, you can sell the property to some related parties and then again get reversed. So all type of things are possible with respect to related party transactions. So again, this becomes an important key risk, and we must see that in more detail. And clear title of property, because if the title is in question, the whole accounting and the whole sale comes into question. So these are the key risk areas, friends, which I felt I must list down. There could be other areas also, but these are some of the key risks which I could think of in the real estate market. And how do I really dovetail my audit plan to take care of key risk as well as other items? So those are the areas I have listed on the right side. So those could be like revenue recognition, how you're ensuring it, construction budgets, advances paid towards land procurement, inventory. So what is the inventory lying in your books, how you're treating it, how you're impairing it, related party transactions, investments or loans and advances, borrowing cost capitalization, other areas, let's say on going concern, DT, other aspect, customer claims and litigation. Again, we'll discuss that. That's, I believe, is an important area to be seen when we do the audit, and unoccupied investment property. So these could be the areas based on which your entire audit plan should be dovetailed to see that we take care of majority of the risk which is relating to this department or this sector, sorry. Right, hope I am clear so far. I know your voice will not come, but you can put as your comment in case if you feel that there is anything which is not clear or you're not able to hear, anything like that. Yeah. Having identified the risk, it is important that the industry itself works on the mitigation of risk, and we as auditor are actually seeing that what are the mitigation plans which is in place in the company, right? So it is actually for the builders or the developers or the companies which are running, it is for them to have the mitigation. As an auditor, I have to see that against all this risk, what are the mitigation plan which the companies are having, how they are actually dovetailed their all controls and processes and their systems in a manner so that they are able to take care of this risk which is there, right? So first of all, of course, for any risk mitigation will be that the company should have a proper risk management framework. If there is no proper risk management framework, of course, everything will fall down, right? So we must see that how is the risk management framework in that entity, whether that risk management framework is dovetailing all the key elements, whether it is dovetailing all the key risks for the respective areas which are there, and how the company is actually taking care of all that risk. What are the processes? What are their plans? So once they have identified the risk, they will also have to identify as part of your ICFR testing that what all controls they are having, and then to test it, whether those controls are working fine or not. So this development of a risk management framework in any of such company is an important element. And once it is there, then what are the key elements by which it will be controlled, and how the company, forget about auditor, how the company has a system of checking whether those systems are working fine and those risks are minimized. Of course, it cannot be ruled out 100%, but how they are ensuring that it is mitigated or to control to a large extent. So this is the first thing which any entity working in this industry should have. As an auditor, when I start my audit, I must go through this process first, see on the risk register, check what are the key mitigation plans which they have, and whether that is working properly or not. Second, of course, this is an industry where the dispersal should be based on a milestone, that what are the actual work done, whether the payments are linked to the actual work done, and also the regular site visits, because it should not be only on the books, it should not be only on the papers, it should be reflected in the actual project. So that is the second one which has to be in place to ensure that the risk is getting mitigated. Third, nowadays it is very, very important, and that is to use that data analytics. Because the size of the companies have become larger, the number of transactions have become enormous, the quantum is significantly high. In real estate companies, if you have a building getting constructed with 400-500 flats, there will be 400 to 500 customers which are in there with whom you will have agreements, you will have different terms, different rates, different payment plan. So all those things are not properly, not feasible, I say, to have based on manual things, or to have only from the system auditing. You need to have proper data analytics to do that. So how they are actually recording the inventory, expenses, payments, progress reports, for all of that, you must use data analytics. So that will help you to really mitigate the risk relating to this industry to a certain extent. The more you use data analytics here, the more your overall auditing will be much better. Next, periodic audits. Only year-end audit is not advisable for the real estate industry. You must see on a periodic basis as to what is going on, how's the project progress, and other stuff. Next is the cash transaction. I think we have already talked about it. There should be clear guideline in the company with respect to the acceptance of cash or even for making payments in cash. For both the sides, there has to be a clear plan. And our plan, our audit program should dovetail in a manner so that we are able to catch if there are any cash transactions happening at any level, even though not accounted in the books of account, right? So I understand that it is not feasible or possible most of the time, many of the times, but there could be indicators for you to go through more in detail and find out if there is anything like that happening. Next, for the mitigation of the risk is strong legal and compliance team. As I've already talked that this is the sector which is highly regulated. A lot of compliance requirements are there. A lot of reporting is there which they have to do to various agencies, including RERA. A lot of approval system is there, and one approval missing could result into a problem at any stage of the work, and the work can be stopped at any point of time. And hence, a very strong compliance team is needed in the company. We must evaluate that what is the compliance team, who are the key people working in that, what are their qualifications. That will help us to determine that they have a proper risk mitigation so far as the compliance is there. Because first thing is you need team, you need people. Then what are their systems, what are their processes, what is their checklist, how they are really controlling all those aspects. Similarly, on the legal side, why legal is important? Because again, this is a sector which is one of the most litigated sector. Builders, while having agreement or while selling flats or offices, they give a lot of assurance to the customer. They give pamphlets, they give a lot of understanding, we'll do this, we'll do that. Maybe they are not able to do that. Maybe they are not doing it deliberately. Maybe they are telling something else in the brochure, but when they're entering into the agreement, it is mentioned something different. Because of all these things, there are a lot of litigations which are happening. The customers are dissatisfied, the customers are not happy, they go to such various extent with respect to the projects which are going on. If there are delays also, there are litigation. So because of this litigations, this legal team and the legal terms becomes important. And hence, it is important for us also to ensure that we train our team to see that the legal items or the compliance items or the are strong enough, and we are training our people properly to see that they are fully aware on the legal and compliance side. So training on the legal terms and update on the real estate rules and regulations is really important for all the team members which are working in that area, because that knowledge will only make sure that we are able to do that checking properly, have proper checklist, and ensure that we are able to do that. Next, like any other sector, an effective internal audit system. Of course, here also it is equally important, if not more, that the internal audit system should be a detailed one, considering the size of the business. Nature is such which requires it, but size is something which will determine that what should be the strength, what should be the qualification of the internal audit team, what should be the periodicity of the audit, what all areas they have to cover. So that all will depend. But ultimately, the key thing is that we need an effective internal audit system in the company. As an auditor, we must see that at the initial stage, which will help you to develop your own audit plan. So suppose the internal audit team is really strong, their scope of work covers most of the items. In such case, you will find that in some of the areas you may see to it, you may in fact reduce your sampling or other stuff to some extent if the internal audit is capturing it properly. So this internal audit system being effective is a critical area which must be seen here. Then title of the land. Again, a significant issue so far as the mitigation of risk is concerned. So any project which is happening or which is being done or to be done is on a land, right? Because that is the main raw material for any project. That is the main source by which it starts actually. So if the title of that land is litigated, if it is disputed, even if maybe that in your understanding or thinking, I mean, your means, I mean, here, company here, they may feel that there's no issue. But if somebody is disputing, somebody is going to a court of law, it creates a lot of issues, not only on the legal title of the land, it impacts all the customers, the way you're going to sell the projects, because any news on the dispute or litigation on the land will adversely impact the entire project. And accordingly, this title of the land, whether it is disputed, undisputed, and legal cases going, it is an important element. And this needs to be seen or to be done at the very initial stage so that you mitigate that type of risk and you do not run any risk on it later on. So these were the key things on the mitigation of risk, which I thought I can talk about it. Going further, friends, we can start with the key areas which I was talking about. And of course, like any other organization, the revenue recognition is one of the most important area everywhere. Similarly, here in real estate also. But important thing is the accounting of the revenue in real estate is totally different as compared to most of the other industry in which you are doing, right? Because here there are guidance notes, there are various elements which come into play while you do the accounting, and there are certain guidelines, talks when you can do the accounting, when you cannot do it, how much you can account. So all those are little different as compared to other industries. That is why I was saying that you must go through the guidance note. You must go through that in case it is as per IGAP. You must go through the Ind AS standards in case if it is under Ind AS, and see to it that you familiarize yourself with the key consideration for revenue recognition before you start checking their account. That should be critical and important, right? Key consideration in my view, which I have listed over here. First, whether the revenue to be recognized over time or at a point in time. So this is always a question in any real estate company, whether you want to do as per a POCM method or you would like to do it based on the completed contract method when the work is fully completed, or you will recognize it over a period. So that is something which the companies decide initially and they continue to follow that at all point of time. So this should be the first consideration while checking on the revenue recognition. Second, how to really do the accounting for barter transactions. So you can have JDA arrangements, you can have various development agreements, you can have fixed price agreements, you can have sharing of revenue, you can have sharing of profits. So there could be various type of barter transactions, and those transactions bring in the accounting complexities with it, not only on the accounting side, but even on the taxation side. So if you have a development agreement, the taxation norms had changed a bit previously, and there are a lot of litigations which are going on with respect to the taxation also. So accounting and taxation, both with respect of such type of transactions, has been a challenge, and it brings the complexity. So we will have to see from case to case as to what are the terms actually with respect to those transactions and how we are really accounting on that. Third, I'll go more detail as we go to the further slides. Third, what are the multiple elements or separate performance obligation, right? So as you know, that one of the key element of the recognition of the revenue is that you are able to do the or you are able to perform your obligations, basically, I should say. So if whether you are performing your obligations, which entitles you to do the revenue recognition. So there could be multiple such elements. There could be separate performance obligations, and you must comply with them while deciding whether you can recognize for the revenue in such transactions or not. So this brings another challenge into the revenue recognition of any real estate player. So this is one of the key considerations. Then accounting for delay compensation. So the nature of the industry is such where there are delays in handover of the project, handover of the respective flats due to one reason or another, what are the reasons for such delays, whether you have to give compensation or not, whether litigations are going on with respect to those compensations or not. So all those things results into to decide what should be the accounting for those delay compensation. So this again becomes complex, and this is therefore a key consideration for revenue recognition. When you decide, you'll have to see how do you really do the accounting for the delay compensation. Then sale of apartments with buyback obligations. There are agreements where you sell it and there are clear buyback obligations to you that after 1 year, 2 years, 3 years, 5 years, you will buy back. And when you buy back, what are you going to pay them? interest or some pricing or depending upon market. So there could be various ways in which those agreements could be there. Hence again, the complexities on the accounting come with respect to the revenue recognition. Onerous contracts, of course, again is a critical thing when you decide on the revenue recognition for any real estate player. One thing you will find in our guidance note or other places is one of the key element is transfer of significant risk and reward. So this is primarily from IGAP perspective that this is given in the guidance note, but it is important to know, that is why I have just brought in here briefly, that it is basically depending upon the terms and conditions of the agreement for sale. So what are the terms and conditions mentioned in the agreement for sale? Whether these terms and conditions are resulting into, in a sense, transferring all the significant risk and reward. Whether it is whether the agreement as such, where the significant risk and reward is getting transferred to the buyer or not, whether that agreement is legally enforceable or not, right? So unless until the significant risk and rewards of ownership is transferred to a buyer by way of these agreements, unless until this agreement is legally enforceable and it is subject to the satisfaction of conditions which signify transferring of significant risk and reward. So unless until those things are there, it cannot be said that the significant risk and reward is transferred. And if it is significant risk and reward is not transferred, you cannot do the accounting of the revenue recognition. So this transfer of significant risk and reward is a little different from the legal title, right? Maybe a developer has entered into an agreement for sale and they have said they will develop this property over a period of 5 years and then only it will be handed over. So possession is not given. Legal title is still not fully given, reason being that they are only developing it and they have a right, they are only developing it, so they have a legal title. It is not yet fully transferred maybe. So that is possible. But if the agreement is such by which the significant risk and reward is transferred, the agreement is legally enforceable, and there is satisfaction of the conditions which signify transfer of significant risk and reward, then you can do the accounting of the revenue. That is what our guidance note as per IGAP says, right? So those are the key things which we have to keep in consideration when we see from the perspective of transfer of significant risk and reward. We go further now on the what could be the audit focus areas when we check the revenue recognition. As I was telling, this is one of the important element which is there in the revenue recognition. So what could be the key audit focus areas? Primarily relating to real estate, we have mentioned, because as I said, here the revenue recognition is a little different from most of the other industry, and hence the recognizing revenue and the entire, if the revenue is getting recognized, it will ultimately result into the recognition of profit also or the loss also. So that is why this becomes very important, because the financial main thing is on the revenue, right? The first risk is whether the revenue recognition criteria is not applied properly, right? So the companies do the calculation as per the POCM method, that is percentage of completion method. So that is being performed by the company, that is performed by the authorized personnel of the company, the entire calculation of the revenue recognition. If there is any error in that, if there is any issue into that, that will result into the wrong recognition. And since this is a little complex criteria which has to be complied with, and you have to have all the data being filled in there, how much you have sold, what rate you have sold, how much you have recovered, how much further you are going to recover, what cost you have incurred, what are the things you have already done, what are the things pending to be done, whatever is pending to be done, what is the estimated cost, what are the contingencies. There are so many elements which come into play into it. So you have to see whether all those elements are in play, whether all those data is being factored properly, all those data is backed by the evidences of the working, and the entire calculation is correct, right? Then only you can say that the revenue recognition is done properly. So whatever this company personnel is doing, it has to be re-performed by the auditor, because it is such that one calculation error, one thing getting missed can result into the error in the entire recognition, and it could be significant. That is why we always suggest that this revenue recognition, which is calculated by the company, should be re-performed by the auditor. That will give the more confidence to the auditor to see that, yes, this has been done properly. So that was the first thing which I wanted to talk about. Second, when we are talking about POCM, that is percentage of completion method, as I said, I was telling that one of the important element is that what work is pending to be done and what could be the estimated cost for that, right? So please understand that these estimated costs are futuristic. It is going to be incurred in future, right? And whenever something is going to happen in future, to estimate that now is always a challenge, right? So whether the company is actually estimating it properly, whether they are taking the updated estimates or not, that is something which we must see. How do we really check that? First, we must see that the operating effectiveness of the controls with regard to the budgeting of the project cost and estimating the cost to complete the project is proper. There are proper maker checker. There's somebody who is making it, somebody who is checking it. It is getting updated based on the actuals, right? Suppose the project is for 4 years. 2 years is over. In 2 years, I was supposed to complete 40% work with cost of say 100 rupees. Now I have completed 40%, but the cost has become 110. Now for balanced 60%, can I say that I'll complete with the same estimates which I have done earlier? No, because reality has changed. The costs have changed, the prices have changed, and hence my estimated cost to complete that project will also change based on the real picture or actual picture which is there now. So this we will have to compare what was the actual, what is the estimated, what we have to do further, and how do I, what are going to be my further costs, and what are the variances, why it is there. So all that will have to be seen and dovetailed properly. Third, to check, as I was saying before also, that it should not only be invoices, it should not only be accounting. The actual progress on the project should be visible. If the books are saying that project is 80% complete, I've incurred cost of 80%. When I visit to the site, I should be able to see it. I should be able to judge it that yes, it looks like that much of the project has been done or completed. So it may not be 100% accurate by just giving a site visit, but it gives you a gut feeling, it gives you an understanding, it gives you knowledge that what it looks like as compared to the cost which is being reflected in the books of account, right? Then we must compare the amount demanded vis-a-vis the POCS per book. So I say my project is complete by 80%, but I have demanded only 25% from the customers. How is that possible? Because most of the times my agreements are such that it is dependent upon the progress. I say that plinth is done, I'll take this. If I have completed level 2, I'll take this. If I've done plastering, I'll take this. So for doing that, what was the estimated cost and how much you have actually demanded from the customers? Once you compare, then if there is any clear anomaly, you will find it. Right? I hope you understand that. So that is why this comparison between amount demanded versus what you are accounting as per percentage of completion method in your books should be compared. And if there is any glaring difference, you must see or check or investigate much more in that. Next item which I must talk about is incorrect revenue recognized as per POC. So there could be, one is calculation, updated estimates. Third is incorrect revenue being recognized. What all we must do in that regard? We must ask for the confirmation of balances along with other project details. We must review customer files on sample basis to identify if any discounts or rebates were to be given, whether that is accounted or not, whether the money which is not recovered from the customer is because of the discounts and rebates which I'm supposed to give, and whether I have accounted on that or not. What are the additional pending work to be done even after handover? So this is another element that even if you hand over the project, there are many times in your agreement or your pamphlet, you promise the customers many more things, which is not completed or not done even when you're doing the handover of the flat. So you have handed over the flat, but suppose you're supposed to do a clubhouse. You have not completed the clubhouse, right? So when you are doing that accounting, you must consider all those additional pending work to be done and treat that as pending work rather than saying that if I have handed over the flat, I have done 100%. No, 100% cannot be said only by handing over the flat or the office. what are the other pending work to be done, that should also be considered while treating or finding out what is the real percentage completion, right? So say if you have handed over flat, you say I have done 100% work. No. What are the other work which is pending to be done, though you have handed over the flat, should be factored. What is the pending cost for that should be factored while treating the actual POCM. Similarly, if there were any amenities which were promised and which is not getting factored in the cost, you must check that. You must check the agreements for the amenities promised. You must check the pamphlets, what have been told to the customers, and you must see that whether all those things are being properly factored in the cost or not. So that is another important element. So these were the things on the POCM. Similarly, on the completed contract method, if there is any company which is going by that, then you must do the inspection of the sale deed and handover documents, which must evidence the transfer of control, because in completed contract, the transfer of control is required. So you must do the inspection and check whether the transfer of control of the property to the customer is done or not while doing the accounting. Next, risk with respect to the revenue recognition is details available on account of Real Estate Regulation and Development Act, that is RERA basically. So we, as I was telling that while doing the accounting, it should not only as per the books of account of the company, you must download the data or detail from RERA site as to what this is talking. Is it matching with the books of account? This is really important, because if we fail to do this, it will be treated that we were grossly negligent in finding out the details. So in RERA, they are saying I have sold 20 flats, and accounting, they have done accounting of 30. It will not work. We must be able to find out. So you can get the details on RERA easily, and then you can compare it. Key things which you can see is details of the sale of units, how much units we have sold, what is the consideration, what is the carpet area, what are the price variation in the units, what are the unsold inventory, because they have given a plan to RERA saying I'll develop so much, I'll sell so much, and they have told you RERA I've sold this much, so balance is unsold. Is it matching with your inventory detail or not? Then the estimated cost, which is basically with regard to the withdrawal funds collected, whether it is matching or not. Form 3 and Form 5 is something in which they submit a lot of details with respect to any project. Once you download those forms, you should be able to evaluate a lot of things with respect to that project. Model sales agreement RERA has given. Are they doing anything different, which is not allowed as per RERA norms? You can see that. Whether the registration of the sales agreement is done or not, what they are reporting to RERA, whether that has actually been done or not. That is another thing you can. So what I mean is that since this is a regulator for the real estate, and this regulator requires a lot of information to be submitted to them from time to time basis, and on a quarterly and annual basis, as and when you're selling, there are a lot of things which is to be submitted. Hence, this work as a ready reckoner for you to compare with your books of account. There should be no difference between what they're submitting and what they're actually using it for their accounting purposes, right? So I hope I'm clear on this. This is actually a critical area while doing audit of any real estate companies. The nature of income, some of the things you can check based on the nature of income, like TDS. So if there is any project, any sale of flat or office, which is beyond a threshold for TDS purposes, on which TDS needs to be deducted, whether that is getting deducted by the buyer or not, whether that is being deposited or not, right? If it is, then you can compare that amount with the 26AS as to what vis-a-vis what you are accounting in the books of account. If there is any difference, it should be properly explainable. It should be something which can be reconciled properly, right? If it is not, then there is a question mark. The company has to really explain that and tell us that why this difference is there. So this is again one element because of TDS in which you can compare that what buyer is talking about and what buyer is deducting TDS and what is there in my books of account. Is it matching or not? There could be different models of a real estate project. It could be selling as well as it could be leasing. So both, of course, the accounting will be different. So if there is something on the selling, it should be accordingly. If it is on leasing, it should be accordingly. That has to be seen. And similarly, if there is on the leasing, then the taxable treatment of leased assets will be different. So that accounting will be done accordingly. This only gives a very, what do I say, a broad picture between Ind AS and IGAAP, right? So the applicable accounting standard so far as the Ind AS is concerned, it is Ind AS 115. That is revenue from contracts with customers. So all Ind AS accounting is driven with Ind AS 115. Whereas if it is other than Ind AS and it is getting accounted as per IGAAP, then the AS9 and AS7 come into play. AS7 is for construction contract and AS9 is for revenue recognition. So both these accounting standards come into play along with the guidance note, which is given by Institute for accounting for real estate transactions. As I said, this was last revised in 2012. So this guidance note become really critical because they have defined various norms in that guidance note, which is not part of the accounting standard as well. So all the three things put together, you will have a clear understanding how the revenue recognition needs to be done in case of IGAAP accounting. Underlying principle, as I was talking, so far as IGAAP is concerned, is risk and reward. If the significant risk and reward is getting transferred and evidenced, then yes, you can do the accounting. Whereas in Ind AS, it is on the control model, where the control is given or not. So under Ind AS, it's only based on the control that you will be able to do the accounting. Then the revenue recognition, in Ind AS, it could be either completion method or POCM. Both are allowed. Whereas in IGAAP, generally, most of the people or most of the companies go with POCM on, right? After revenue, we go to the next one, which is on the construction budgets. As I was talking that the most important element in the cost is on the construction side, especially if you are given to the subcontractors. And then whether you are doing the work on your own or whether you have the subcontractors, there is a cost estimate which is being done. Why this is important? Because based on these cost estimates only, it's not only for estimating and then seeing what you are incurring, but it is also used for accounting. Because if suppose you have done 40% of the work is completed, right? Then what amount you have spent, what amount you are going to further spend, what revenue you have got based on the sales agreement, what revenue you may further get based on the unsold inventory, that combination brings in that what could be the final profit. And that final profit will be treated, considered based on the percentage what is coming, and the same percentage will be applied to the work which is actually being done. And hence, this estimation of the construction budget becomes very important. Now, as I was saying that these real estate projects are not something which is short term. These are generally long-term projects, more than 12 months, basically. In such case, there are also chances of budget overrun. There are chances of cost getting increased because estimate is estimate. The actual will be different from the estimate, right? It cannot be 100% perfect. So all those changes you have to factor in while considering it. That is why if you see the key risk area and what audit procedure we have to do, like if there are budget overruns, what you're going to do, you must see the breakup of specific items along with assumptions at the time of initial budgeting. When you have done the initial budgeting, what was the BOQs, how you had the breakup of the specific item of the cost which you are supposed to incur, and what were the assumptions for that, vis-a-vis what has been done so far on actual risks. Suppose you have estimated the rate of cement will be 200 rupees per bag. Actual which you have seen in last 2 years in which the work is done, it was averaging 210, right? And you have seen that the cost is on the increasing trend. So actual is 210. Based on the estimate of the increasing trend, say in the next 2 years, it will be 215. You must consider 215 for the going period. So that is why the breakup of the specific items with clear assumptions, initially, actual, and what is going to happen is very critical and important, and which you must see. Similarly, you need to verify the key assumptions on the cost and timeline. Compare with other projects. So generally, there are many players which have got many projects running, right? Sometimes you get the answer into what they're doing for any projects when you compare it with other projects. If say in project X, they are saying my cost for steel is going to be 30,000 rupees per MT. And in another project, they are saying, no, it is going to be 28,000. How is this possible? Maybe there are some justifiable reasons in the sense that this location is different, another location is near to some large supplier, which will give me at a discount. So there could be possibilities, but to have any significant difference is in general not there. If it is there, you need to have a proper justification recorded in your audit notes. If it is not compared, if there is no proper justification, then in that case, the chances of things go wrong could be higher, right? Next, that the regulatory cost to be fully factored. As I said, this is a regulated industry, a lot of approvals required. Many of those approvals have significant cost. Like suppose in Mumbai, you know that there are a lot of licenses required, and many times, suppose you are doing a project which is a Mahada project. So you have to pay a lot of money to Mahada to get those approvals for allowing you to do that construction. So have you really factored that? So all the regulatory costs to be fully factored. Then another thing which you can do is you can check the purchase orders which are issued or the agreements which have been done for many purchases. So at what rate those have been issued, at what rate those agreements are done, whether your working of the further cost to be incurred is matching with those purchase orders and agreements or not. So that could be the another thing which can help you to check on the cost overrun or no overrun. Both ways actually will help you to do that. Similarly, resource allocation. So for large builders or the large players, they have a large team which is getting deployed. And it is possible that some of the people, a good number of people are working on multiple projects, right? So if they're working on multiple projects, how they're actually planning, what is the actual time they're spending on the respective projects, how they're really doing the accounting. Is it that person is spending time on project X, but his cost is getting allocated to project Y? You may feel that cost is cost, how does it matter? But it matters because what revenue you're accounting from project X and when is maybe totally different from what you're doing at project Y, right? And hence proper allocation of the resource, proper time sheet for those respective people, proper accounting of their cost becomes really important. So that was the second one. Third, this industry is such where there could be various uncertain expenses. That is why you will see while doing the calculation of the cost, almost every time they factor in the contingencies. So even initial stage, when they make the costing, they put some amount as contingency. Generally 5 to 6% of the overall cost is considered as contingencies. And the reason is very clear. As I said, these are long term. You're doing the estimate now, based on the situation now. What it is going to be in the periods to come is not known. There are a lot of uncertainties. And that is why contingencies are required. So these contingencies are getting calculated at the initial stage, but these will have to change from time to time. Suppose there was a project which was estimated for say 4 years. Now, 3.5 years is gone. Can you continue with the same contingencies? No, because 80% of the period is over, 85% of the period is over. So you will have to reduce it accordingly then. Or if you find something different in the contingency, you will have to calculate it accordingly. So this will have to keep on changing based on the status of the project, right? Second, while treating what should be the contingencies, we must see that again it should not differ significantly between project to project, except cases where the element of risk for any particular state or any project is higher because of regulations being different there or the challenges being different there, then it has to be recorded that why it is different in other project as compared to this project. But you must compare, and any significant difference, you must record the reasoning for it, right? Similarly, if there is any cost of rectification or guarantee work for whatever work you're doing, then in such case, the estimated cost for such a rectification and guarantee work should also be factored upon. Like I give you a simple example that say you are selling a flat and you say you will give a fully furnished flat. And if there is any problem with the furniture or with the painting, say for the next 24 months, I will redo it for you. So that's part of the agreement. So in such cases, you will have to estimate how many such cases could happen. What is the record in other such similar projects, if any, or what could be your estimate for such rectification or guarantee work? And you will have to include that as part of the estimated cost. Last but not the least for construction budget, that is the accuracy and completeness. Of course, the way I have talked about the accuracy for revenue, similarly for the cost that is on the construction side, the mathematical calculation will have to be checked, ensuring that no key elements are getting missed. As I was saying, there are various elements of cost and everything needs to be factored upon. And you can compare it with some of the completed projects. So there are multiple projects in that company, that what were the real costs in those projects which are completed, whether all such type of cost is being factored in the ongoing projects now. So you have to ensure that no elements are getting missed so far as these projects are concerned. We go to the next area now. That's on the advance or deposit paid towards land procurement. As I was talking, for any real estate player, the first and foremost raw material is the land. So unless until they have the land, they cannot go for any construction or sale or anything. And this land procurement is a key element because that also to a good extent decides the success of the project. If the land is at a good place, at a good pricing, the chances for your success gets much higher. And hence, and the amount involved into land is also significantly high, right? It generally differs between 20% to 33% of the total project cost. That is on the land. In some prime area, it could be even significantly higher. But general is that. So the material, the amount is material for land, right? And also there are cases where the land procurement involves a lot of give and take, and hence this checking also becomes significantly important. So first, like I was telling for any other case, is to understand the process, understand how we are giving the advances for land, what are the key controls in that regard, who shall be doing the first survey, who will prepare the report, who will approve it, who will have final approval, what are the key elements which are required before final approval, like due diligence is required, market assessment is required, what sort of agreements are required. So all those things which are critical for it needs to be defined, and it has to go through a proper system and control that how the same is happening, right? So as an auditor, I must do that testing. I must see that the process is there and the process is working fine. That is the first element. Second, the existence and the rights and obligations. So the whole land for which you are giving advance is the cornerstone of the further development of that project or the success of that project, right? And hence it is important that when you are buying any land or you are blocking any land, the agreements which you are having or the MOUs which you are having should be proper, should be properly vetted, legally vetted. So you go through what are the agreements, what are the MOUs, how the same is working based on which they are giving the advances. What are the timelines? Suppose it says that, okay, I'm having an MOU and the land will be provided to me after 5 years. So whether it will serve the purpose? No. Whether you can start doing anything on that? No. So you will have to see what are the timelines which are mentioned in the agreement as well. Confirmations, of course, that is an important process for any of the critical items or material items which we have. So whether we are obtaining confirmation, so the key terms, what has been paid to them, we are taking confirmation or not. So that is an important aspect. Third, special consideration in case of land aggregation. So there are places where the developers do the land aggregation. What does it mean? That there are land owned by different people at a place. They try and buy land from all those players. Even if 1 or 2% will not sell, it may result into a problem. So in such cases, many of the times they do not go through a full legal compliance because they are in a hurry to do that aggregation. So then the risk remains. That is why it is important wherever there is such cases of land aggregation, you check that what are the legal experts' views on that, whether there is a clear title deed clearance before they are buying that, whether they are complying with the laws or regulations or not. Are they entering into MOU with the landowners or with some agents? So all those things will come into play wherever there is a land aggregation coming into there. Of course, ownership of the land of the proposed seller in any case is critical to be seen. And we must have the documents. If I am paid advance to X, I must have the proof or evidence that that person to whom I have given advance is actually owning that land. Because whether I should say that or not, but there are many cases which we have seen where that in various forensic audit that the advances were given without having any record or evidence of the land by that person. It was just shown an MOU was entered, but that land itself doesn't belong to that city. So that whole purpose of for which this MOU is done or agreement is done of no use. It was only frivolous. It was only for the purpose of fund diversion. So we must check the ownership of the land of the proposed seller to whom we are giving advance or we intend to give advance. Next in that land procurement will be once the advance is given, then we need to, and then say the work has not started, the land is not yet registered and it is still there as an advance. In such case, we need to assess the recoverability of the advance or the viability of the project, considering the period which has elapsed and what further development has happened, right? So what all we need to do to check the recoverability or viability? First, obtain a detailed summary from client management on the status and plan for conversion to land stock, obtaining of audit evidences as regards subsequent deployment for land purchase, review of utilization advances which has been given to the land aggregator, do a site visit, do a benchmarking, what was the total contract value, what is the market rate, what is the guidance value, confirmation you must obtain the valuation reports. So all those things you need to do, which will help you to determine the recoverability or viability of the project. Next is on the litigated land properties. Litigation is very common into a real estate industry basically, and hence we have to be extra careful while checking on the litigated properties. It is not easy for us to come to know whether there is any litigation going on, and hence extra steps or extra work needs to be done from our side to see that we come to know if there is any litigation. First, we suggest that we must go through the minutes of the board or committees where all the material things are getting recorded, litigations are recorded. So we must go through and we must have access to all those boards or committee meetings minutes. Second, if there must be legal counsel or there might be in-house legal expert working with the company, we must obtain confirmation letters from them and analyze for each, along with their analysis first for each case, and then our analysis on those cases as to what is actually happening and how it is going about it, right? And if there is any significant uncertainty involved, then we have to do accordingly our audit reporting and whether provisioning is required or disclosures are required, whether it is contingent, whether it is actual liability, all that which is required as per our standard will come into play. The last thing in the procurement, land procurement I can talk about is the project cost estimation. So as I said that the cost estimation is a critical thing. So even if there is only a land and the project has not started, right? So as I said, for recoverability, two things. One, if I want to sell the land as it is, what value I will fetch. Second, as and when I do the project, what will be the real realization or the net profit coming out of the same. So for that, you have to do the proper estimation of the cost, which is done by the management, and you need to also evaluate it further. And this cost needs to be revised on an annual basis so as to factor the inflationary impact or the revision in the project model if there is anything happening because the work has not yet started. And all those estimates of the changes will require proper disclosure as well if it is material. We go further now, friends, on the inventory, project inventory. So project inventory, because see, what are the key elements in the balance sheet of any real estate company, right? You have, say, bought a land, you are doing construction there, say, of a residential building. To the extent you sell it, you recognize the revenue and you show as debtors. To the extent you realize the money, fine, balance is being shown as a recoverable from the customers. But the most important element which is there, because whenever you're doing any project, you're not selling everything or you have not sold everything. So whatever is left out inventory, whatever is the left out flats or offices or whatever, will be reflected as project inventory in your books of account. So for any real estate companies, except those which are having limited projects and at the end of completion, otherwise this inventory will be a material and major component in any financial statement. And accordingly, the audit plan which is being dovetailed or the audit procedures which you have to do for this should be seen more in detail, and we need to really focus on the same. So key things which I suggest as audit procedure over here. First, what are our controls over vendor evaluation? How we are really doing the selection of vendors, how we are really doing their evaluation. It starts with that because it is from the vendors that you are getting the inventory. It is from vendors that you are paying money for doing work, whether for service or whether for equipment, whether for items, whatever. So we have to start with checking the controls over vendor evaluation or selection. Second, how is my procurement process? What are the IT controls in the same? How are we doing the three-way match to check the same? What are the PMC certification happening? How is the RA bill verification done? So if I have a vendor and who is supposed to do the work over a period of 2 years, he will be raising bill as and when as the milestone is there. It could be once in 15 days, it could be a month, it could be based on certain milestones. He will be raising invoice. So how that bill is getting raised, how we are verifying it. So all that will come as part of the procurement process in which you will have to see the same. Then what is the policy which is there around the accounting for a stock of building materials? Please review that. We will have to go through the same properly. Similarly, what are the controls around the project-wise identification of all direct costs? So as I said that if there are multiple projects going on, maybe they have bought some material, but it is bought for project X, but put in project Y. It will change the entire game because project X, maybe the revenue has to be recognized after 3 years, but why it is getting recognized now? So the whole accounting will be different. So how that control is there, how that is getting identified for the respective project. Data analytics, of course, I have already talked about. This will help you to identify any red flags which are there. Apart from direct costs, there are many common costs which is getting allocated to the respective projects. Again, that how this common cost is getting identified. What are the common costs which can actually be debited to a project? That is the first thing, right? And then whatever can be debited, whether it is getting allocated properly to all the projects. So same mechanism which is there to identify and allocate the same will have to be seen thoroughly because this again can alter the entire accounting which is happening, right? Next is like books of account should map the cost relating to the respective project. So the revenue and the cost should go hand to hand. It should not differ. So if I am recognizing revenue, I must recognize revenue also relating to cost also relating to the same project or the same number of items for which I am recognizing the revenue. As I said earlier, also if there is a clubhouse, mall, school, then we must see that whether how actually it is getting accounted, whether it's part of the project, whether I intend to run them all separately. So it will all depend upon what is my intent, how I want to use that in future, how I want to treat that in future, and accordingly proper accounting will have to be decided whether it is an investment property or property, plant and equipment or inventory, and accordingly the treatment will have to be done for the same. Next, if there are any bookings which is made subsequent to the balance sheet date, it needs to be evaluated that at what rate the booking is done, whether my cost which I have incurred and going to incur is more than that at which I am doing the booking. In that case, you may have to book more losses in your books. So all that working will have to be seen based on what are the subsequent bookings which have been done subsequent to the balance sheet date. That should need to be seen. Another thing in the inventory will be their valuation. So how the company is actually valuing those inventories, that again is an important item, material item. Few things are very clear. Like first, if there is any selling and distribution cost for a project, it cannot be inventorized. It cannot be part of the inventory cost. So if there is any selling and distribution cost, maybe initially the company has done significant amount spent on the selling and distribution. They have done a lot of advertisements, X, Y, Z, but that cannot be put to the inventory. It cannot be apportioned to the inventory. It cannot be apportioned to the project. It will have to be debited to P&L directly. So that is another important thing to be seen, that it is not getting inventorized. Second, we have to see whether the control levels over the investment property are getting classified properly, whether the categories are proper, like whether it is treated as inventory, PP, or investment property. As I said earlier in the previous slide, it depends upon the intent for the respective items. And accordingly, the classification will have to be done. Next, whether the carrying value of inventory includes any unrealized profit. I hope we all know and we are all clear that unrealized profits cannot be included as part of the inventory. It should be the actual cost inventory and not the unrealized profit. The unrealized profit will be considered as realized and accounted as and when we recognize the revenue. Otherwise, inventory cannot include the unrealized profit, right? In the inventory valuation itself, another important element is capitalization of indirect cost to the projects. How the allocated overheads are getting capitalized. This again is a critical element which makes significant difference to the ultimate accounting which is being done. There should be a thorough review of the management identification of other costs, how they are actually seeing that what cost can be inventorized, what cannot be, how it is getting allocated, what is the basis of allocation. And few things the standard says very clearly that it should not be inventorized. It should not be treated as indirect cost of projects like general administrative cost, unless until it is directly relating to the project, any research and development, any depreciation of idle plant and equipment, if there is any cost of unconsumed or uninstalled material, if there is any payment made to subcontracts in advance, then it is not part of the project cost, it is only in advance. So all those things cannot be included. Next important item for which you need to check while doing the audit of project inventory is NRV testing, right? Net realizable value. So naturally, you have to find out, as I was talking earlier also, what is the estimated cost to the recent selling price. So suppose I sold some flat at 5,000 rupees a square feet in March, and my working says that the cost which I've incurred and to be incurred both together is going to be 5,500 rupees, right? Now this 500 rupees, can you defer it? No, I mean, my whole concept of the inventory is based on the cost of NRV, whichever is lower. Similar call will come over here that in case if I'm going to incur losses while selling the inventory in future, those losses will have to be accounted now. So we have to do that working. We have to compare and check. We have to put sensitivity analysis. We have to obtain the valuation report. We have to do reconciliation of unsold inventory vis-a-vis what we have in our books. And after doing all that, we have to find out whether my basic criteria of NRV or cost, whichever is lower, is being factored or not. If there is any loss coming, I'll have to do the accounting now. We go to the next topic now, which is on the investment property or PP, right? In this case, I mean, there's not much in general in the industry, but few things, few cases it comes as investment property and other stuff. So we must determine the period of capitalization, how the same is getting capitalized. We must conduct a physical project site to check the physical progress of the such investment property and determine the parts of building, how they are determining that it will be done, what should be the value, what experts they are using. So all those things we have to check. And ultimately, the critical thing in this case will be the impairment assessment, right? We will have to see whether there is any indicators which are existing for the impairment. What are the parameters which they are using while doing the fair valuation of those properties? What methodology they are using, what growth rate they are using, what WACC rate they are considering. So all those things will have to be factored upon. And as an auditor, I am supposed to go through those assumptions. I am supposed to go through those estimations and then see whether the fair value of the property is matching or not. Next area, friends, I go is investments, loans and advances, right? So in any real estate companies, like any other companies as well, they do make investments, they do give loans and advances. Why it is important or critical here? Many times the companies, other group generally will have multiple companies which are doing projects, right? And one company will be giving investments or loan to other entity of that group itself, generally, or maybe even other than group, for doing their projects. And accordingly, this item becomes important in generally in large real estate players, that what are their investments, what loans and advances they have given. So in case if it is there, primarily for the related parties or group companies, key audit procedures which we suggest is one, whether it is properly approved by the audit committee or by the board of directors or by AGM, wherever required. and whether proper necessary authorization for providing such loans advances or giving such investments or making such investments is there or not. So that should be the first part. Second, whether the terms and conditions are such which you believe could be prejudicial to the interest of the company. Like suppose you are borrowing, or the entity which you are auditing is borrowing a loan at the rate of 9%, but you are giving to your, say, one of your associate at 7%. Now, why it is not prejudicial? I mean, let the management justify whether they had significant management fund into the company to give that at 7%, or how much amount they have brought in to give that, how much interest-free loan they have brought in to give that. So all that justification will be required. If it is not justified, then it could be prejudicial. So that is the important thing which you will have to see. Third, just having approval and having proper terms and conditions is not sufficient. You have to see the business rationale for that investment, business rationale for that loan made. What is the economic substance? Why I am doing it? I mean, if I am doing only for the sake of doing and giving money there, and they are actually not using it for the purposes for which I am supposed to be or for which I have given, and it is being used separately, then there is no business rationale for it, right? So business rationale for giving these investments or making these loans is equally important in my view. Once given and technicality is seen and approval seen, the next thing will come into assessing the recoverability or whether there is any impairment. So again, the same things here. We must have proper valuation reports if there are investments. We must see that the assumptions used in the valuation assessment, either done by the management or by the experts, are proper, are realistic, are not changing year to year significantly. And if there are, if the things what they had estimated earlier, if those are not happening, whether those are being considered accordingly or not, right? Another important thing must be that we must obtain the last audited financial statements, and it should not be old enough. It should be the latest audited financial statement. Like suppose every company is supposed to have March balance sheet to be filed by September, and if they have not done that, it means there are issues. There could be issues why it is not getting done. So as per the timeline, the financial statement should be out. We must be able to have access to it. We must be able to see from those audited financial statements as to what is the actual worth of that company, what is the financial condition of that company, how they have actually utilized the fund in that company. So all those things will be critical to see from the financial statement of the entities to whom we have given loans or advances or made investments, right? Third, whenever I give any loans or make investments, we must inquire with the management. What is the status of that project? What is the business plan? How it is progressing? Is there any bottleneck? Is whether those bottlenecks can result into any impairment to those loans or advances? So that we must take from the management, and we must do a proper assessment. And of course, last thing is balance confirmation, which is generally as per our standards which we obtain. We should do that here as well. Those were for the loans given, even for loans received, because as I said that in such cases there are concerns on the routing of funds that we have given somewhere and they've taken money and shown as a project promoter fund and other stuff, and hence the amount received also needs proper focus in such cases, right? So if there are any loans received, we must check what is the nature of that, whether what is there in substance, what is the terms and conditions, whether it is an actual loans and advances or these are project advances, whether it's disclosed and classified accordingly, is there any back-to-back arrangements? So all those things will need to be seen in that regard. Similarly, if there are any advances from customers which is being shown, we must map it with the sales register, whether it is mapping properly, what is being reflected in financial is getting mapped with the sales register. If there are any cancelled flag for which the amount was received and now it is being shown as advances, are we doing the booking of interest, which is required as per the RERA norm? If I'm not paying for the cancellation of the flat as within the prescribed time, then as per RERA norm, I have to pay interest, whether the builder is accounting that interest in the books of account or not. Another important thing in the advance from customer is GST, because GST becomes applicable whether you have accounted the revenue or not. If you have received the amount, then the GST becomes applicable. So have they collected or not? Have they deposited or not? So all those things will have to be seen so far as advances are there. Now we go further on the related party transactions. It is the same like which you do at everywhere. Basically, the only thing is that since could be multiple projects, multiple companies, and hence proper focus is required on it, right? So we must go through the policies, procedures, check the arm's length, approval mechanism should be proper, it should be recorded proper in the registers, it should be disclosed properly into the financial statements. And as an audit procedure, I must add, we must go through the minutes, we must go through the regulatory reporting which is being done to them. We must have proper checklist to see whether the Companies Act requirement, Ind AS requirement, SEBI requirement are all being complied with or not. So that is what is to be seen more into that. Approvals are really important, whether AGM, whether board, whether the audit committee, as per the requirement which is defined, it should be there. Right. Then corroborative evidences through external confirmation we must obtain. We must do the benchmarking study to see the terms and condition, whether it has been done at the same terms and condition which I would have done with outside party or not, whether there are valuation reports with proper assumptions which you have weighted to satisfy that arm's length transaction or not. So that all we will have to see. Another important thing in the related party will be the undisclosed arguments. One is what is already disclosed by the company, where there you will see what approvals they have taken, what is the arm's length and other stuff. But I believe one critical thing is to find out if there is any RPT transaction which is not getting disclosed, right? So we must do independent testing of some of the material creditors, material debtors, material advances, check whether there is any related party relationship with those entities or not. Whether I am taking details while onboarding vendors and whether we are flagging properly the related parties or not. Whether I am comparing with the disclosures given by the board members and senior executives of their related party listing, whether I'm comparing with any such companies with whom I have transaction, I'm properly declaring as a related party or not. Whether I'm doing something to check whether there were people who are working with the company earlier or now, and we have any transactions with those parties, whether those can be treated as a related party or not. So those are the key things which you must check to find out if there are any undisclosed related party transactions. That will be a key element from the audit perspective, I believe. A few other areas which I can say for the real estate players. One is on the borrowing cost capitalization, right? So this is something which is important considering the fact that these are long-term projects and most of the cases the entities also borrow money, right? Two, three important things is that in case if you have borrowed money and you have deployed it for the short term and put it in say FD and mutual fund and you're earning income from that, that income should not be shown as income. It should be reduced from the project cost, right? So that is one important thing which we must take care while seeing this borrowing cost capitalization. In case of land, we must see whether if I'm doing any borrowing for the land, whether it is a qualifying asset or not, and whether I can really capitalize those costs or not, depending upon the time to be taken for the completion and other stuff, we will have to see that. And if there is a running project, if there is a general borrowing, if there is a specific borrowing. The specific borrowing for projects are easy to capitalize, whereas general borrowing, you'll have to really figure out whether that money is utilized for this particular project. Then only you should be in a position to capitalize it and not otherwise, right? These were some of the things on the borrowing which I can talk about. I think we are running over time now also because we want at least 5-10 minutes for question answer. So I'll just run through 1 or 2 slides and then we'll go to the question answer. Right, other areas, customer and other litigations. Friend, this is really critical in real estate because as I said earlier also that the customer files claims, they file litigations. It could be on account of delay in project, it could be on account of defect in project, it could be on account of non-compliance with the builder on certain things and certain things. It could be on various aspects. So if the customer has filed litigations, we need to have proper detailing and data for it, right? And then we will have to assess what are the chances for these litigations or these liabilities crystallizing on the company. There are certain things from RERA perspective that they have to pay. It will have to be paid today or tomorrow. So if there is any such case, you will have to do the accounting as a cost, and it will have to be routed through P&L. If there are certain things which is only contingent, the chances of their getting crystallized is less. In such case, you will have to give the disclosure in the financial statement. So this customer claim related thing will have to be seen properly. especially if there are multiple projects, there are large number of customers. We have seen practically there are huge amount which comes into play. In fact, suppose one project was to be done and that project builder is not doing now. He has 10 projects, one project he has surrendered, he is not doing now. Now the customers are claiming compensation, whether he will have to pay compensation as per current rate or he has to refund only the original principal, what litigation is going on, what has happened on those litigations. So a lot of things come into play with respect to customer claim related litigation, which must be seen carefully. Similarly, land litigations. If you have bought any land or given advances, litigations are going on, then what is the risk of non-recoverability? What litigation is going on? What are the legal counsel saying? That again becomes an important aspect. DTA, I think it is simple like any other company. In case if it is as per IGAP, which you are preparing, then you will have to see that reasonably certain versus virtual certainty. You will have to see while accounting for the unused tax losses. Nothing different. So I'll not spend much time. Going concern again, because multiple companies, multiple projects are there. Some companies are doing well, some not. If there are losses, if there are cash flows not happening, if the projects are significantly delayed, on such cases, you must assess the going concern properly, take a detailed note from the management, take a projected cash flow from the management, and satisfy yourself before giving anything on the going concern. Audit trail, I think this is again generic for applicable for all the companies. Primarily, basically, you need to have your own, you need to have proper accounting software, which is having a feature of recording at the audit trail. It should operate throughout the year. It should not be tampered, and it must be preserved as per the statutory requirements. So this is generic, which is there for any other company. So I'll not spend more time. I think that said, the last slide is on NAFRA. Again, some of them are common one, whether independence or inadequate evaluation of risk of material statement or EQC are not effective. One or two specific thing was, which is pointed out in real estate companies, were like not having proper use of auditors, experts for technical work, like completed projects or estimated cost of construction or impairment, or relying on the legal opinion just provided by the management and not doing your own detailed review. So that was one factor specific to real estate, which has come into some of the reports given by NAFRA. That's it from my side, friends. Thank you so much. And if there are any questions, I shall be happy to answer.
Yeah. So thank you so much, sir, for such an enlightening session. We would like to extend our sincere gratitude to you for taking the time to be our guest speaker for the session and appreciate for the time and effort you have invested in customizing the presentation for our audience. So now I would like to take up the questions which have been asked by the members. So the very first question is how to deal capital gains when the development agreement is entered by a landowner in lieu of constructed area.
So as I was saying that they must familiarize themselves with the income tax. In fact, 4-5 years back, that was clarified that in case of development agreement, there will be no capital gain tax at the time the development agreements are entered. But when the project gets completed and the project gets the occupancy certificate, that is OC, from the relevant regulatory authorities, that is the time it will be treated as transfer. And that is the time you will have to pay the capital gain on that. And various litigations are going on. So I mean, it's a separate topic in itself to discuss in the nuances. But primarily, you can say that if there is any development agreement, earlier it used to be that when you are entering into development agreement, you have to pay tax, which was set aside, and the government came with the notification saying not at the time of entering into the development agreement, but when the project is complete, whether it is sold or not, that's a secondary issue. If the project is complete and OC is received, at that time it will be treated as transfer and they will have to pay capital gains tax.
Thank you, sir. So the next question is, in the case of apartments, the purchaser, who is the owner of the apartment, pays 45 lakhs and more, in due course value go downwards. How unsold apartments are reflected in the books of the builder?
So I was already talking on that, Drishti, basically. I said that in case your actual cost incurred, right? I think they are asking from the perspective of builder only, because we are not dealing with the buyer over here. We're dealing with how the real estate companies will do the accounting. So for the real estate companies, In case if you have sold projects at price X and your estimated cost is higher than that, then the difference will have to be accounted as loss now rather than as and when you will sell the property.
Thank you, sir. So the next question is, if the project completed in December 2023, is it required to file the annual return for the financial year 2023-24?
Yes. So the quarterly reporting and annual reporting is mandatory for all the projects with RERA, right? So all quarters they have to report. And if it is completed in the financial year 23-24, then naturally the annual report will also be mandatory. So it is completed in December 23, as per the question. So this is completed in the year 23-24. So this will go in the annual report as
well. Okay. So the next question is, in the financial audit, labor who are given cash on daily construction working basis, how that expense is to be audited?
This is a challenge. I mean, if there are, that is why I'm saying that cash transactions need to be avoided. But in case at certain times it is not practical to avoid that, and if there are construction worker to whom you are paying daily cash as wages, of course, as an auditor, you will have to see that what are the controls built around it, what are the evidences built around it. Controls could be like there will be definitely registers for the entry of those workers. It will show the entry time, it will show the exit time, it will show that what are their names and if what are their EPF details if they are registered with Provident Fund authorities, because they are supposed to pay minimum balance, minimum wages as well to all those people, even if they are temporary. So they have to pay more than minimum wages. So they must be registered and they must reflect that whenever they are paying, they must be taking their signatures. So all those evidences and all those controls which are in place with respect to those transactions will have to be seen and audited by the auditor.
Okay. So the next question is, are the landowners covered under RERA for the share of flats allotted to them regarding deposit of funds in separate bank account, etc.?
So if there is a landowner which is doing the plotting of land and selling it to the public, in that case, they are going to receive money from those people to whom they are selling that land. In such case, they have to register with the RERA. Because as I said, it is not only for construction of the building or offices, it is also if you are doing the plotting of lands and selling, you'll have to register. But if you are only a landowner, you're not going to do any plotting, you're just keeping it yourself, you're not coming with any project. In that case, you don't need.
Okay, just for the plotting purpose, we don't need to. Okay. So the next question is, if the agreement for sale is not registered and the promoter received advance more than 10%, then can the CA issue quarterly certificate stating that the promoter in compliance with section 4 subsection 2 1 clause D?
It is not in compliance, Drishti, because RERA guidelines says that you cannot get more than 10% without having the sale deed. So you need to have the registered sale deed before you get more money. If you have got more, the auditor is supposed to put that in the certificate saying, if these are the cases or these are the exceptions in which they have got more than 10%, which is not in conformity with the norms.
Okay. So the last question, one major area which results in cash transactions in real estate sector is the difference between the market rate and the circle rate. How an auditor ensure that there is no material misstatement due to this issue in revenue recognition?
This is $1 million question. It's really, really challenging. It's very difficult for any auditor to really identify. So as I said in my presentation also, it will not be practical to just pinpoint saying that this is here you have taken cash. Unless this can only be done by somebody who's doing the raiding, income tax department, if they raid it and they find any document and other stuff. As an auditor, it is not practical to pinpoint, but at the same time, there could be various pointers. How the pointers could be, suppose you have sold the same flat to person X at 24,000 rupees in the month of June and to person Y at 20,000 rupees. So this is a clear pointer that there is a difference of almost 20%. And you're selling the same thing in the same month or nearby month. So how that could be practical? It is not, it cannot be only because of the negotiation power. In such cases, we must definitely ask for more roving questions with the management. We should ask and find out what could be the justification of it. And if you are not able to get proper justification, if you have your suspicion, I think you will have to do additional procedure or may even need into qualification of the report.
Okay. Thank you so much, sir, for answering all of the queries. So before handing over the session, I would like to thank you once again for here to be enlightening our audience, but also stimulating thoughtful discussion after the session. Thank you so much, sir.
Thank you, Drishti. Thank you so much.
Thank you so much, sir, for such a wonderful deliberation and covering all the aspects relating to this audit consideration relating to real estate sector, and really wonderful to hear the insights from your side relating to the topic, and you have covered all the aspects. So from the core of my heart, as well as on behalf of AASB of ITI, I extend my heartiest thanks towards you, sir, for sharing your knowledge and experiences with all our esteemed members. Thank you so much, sir. I also thank Dishti Madam for sparing your time and wonderfully coordinating today's webinar. Thank you so much, ma'am. Thank you so much, sir, for giving your kind consent for the
Thank you
webinar.
so much. It was my pleasure to interact with you.
Thank you, sir. Thank you, sir. Thank you, sir. Namaste.